Study: increased emergency visits among Chinese investors due to stock loss pressure. Foreign investors disappointed, $15 billion in China, massively selling A-shares. China's domestic demand weak, multinational companies, consumer confidence extremely low. China's financial teeth scandal, Billion-Yuan money laundering and investor exploitation. Wall Street cuts hiring, Chinese students face increasing difficulty in finding financial jobs. Massive spending and the politicization of sports, CCPs Olympic system criticized. It's all covered in today's China Truths. Study: increased emergency visits among Chinese investors due to stock loss pressure. A study, published in the journal Nature Mental Health in June, has revealed a concerning connection between the volatility of the Chinese stock market and the physical and mental health of investors in mainland China. The study says how stress stemming from stock market volatility can trigger both cardiovascular and mental health issues, ultimately leading to an increase in emergency room visits. Researchers analyzed daily emergency room records from 3 major hospitals in Beijing between 2009 and 2012. Their findings indicate that for every 1% drop in the daily market return rate, there was a corresponding increase of 0.185% in cardiovascular disease cases and 0.020% in mental illness cases on the same day. The study further estimates that a significant 10% drop in the daily stock market return rate could potentially result in an increase of approximately 3.5 million yuan, or roughly $490,000, in medical costs associated with emergency room services across the nation. The researchers said that the impact on health is not only substantial but also immediate, disproportionately affecting older individuals and men. This phenomenon isn't new. In July 2015, following a sharp decline in Chinese stock prices, doctors reported a surge in patients presenting with what they termed stock anxiety disorder. Media reports from that time highlighted instances of college students interrupting their studies due to their preoccupation with their investments, and investors seeking counseling to cope with the emotional and financial fallout of the market crash. While the study's data is over a decade old, the researchers note the need for further investigation using more recent medical and financial information. Anecdotal evidence on Chinese platforms like Xiaohongshu supports the notion that stock market losses continue to inflict significant psychological distress on Chinese investors today. The number of stock investors in China has skyrocketed from 29.3 million in 2000 to a staggering 322.6 million in 2022. This dramatic increase means that market volatility now has the potential to impact the financial well-being of a vast number of individuals and their families. The Chinese stock market has faced significant challenges in recent years, with investor confidence shaken by the pandemic, a crackdown on the tech industry, and a downturn in the real estate market. The benchmark CSI 300 index has seen losses for 3 consecutive years. Amidst this economic uncertainty, many Chinese families have been forced to cut back on discretionary spending. The study's findings disclose the profound connection between financial markets and individual well-being. While diseases unrelated to psychological stress remain largely unaffected by market fluctuations, the study suggests that mental and cardiovascular health are particularly vulnerable. The researchers also suggest the possibility of further research utilizing digital medical data collected during the COVID-19 pandemic, when online medical consultations became more prevalent. This data could provide valuable insights into the ongoing relationship between stock market volatility and public health. Foreign investors disappointed, $15 billion in China, massively selling A-shares. In a report released on August 12, Bloomberg highlighted a trend, a significant withdrawal of capital from China by foreign investors during the second quarter of this year. This record outflow signals growing pessimism among investors about the Chinese economy. Official data from the State Administration of Foreign Exchange, or SAFE, confirms this trend. Last Friday, they announced a decrease of $14.8 billion in direct investment liabilities between April and June. This translates to a net outflow in foreign direct investment, a phenomenon observed only once before since records began in 1998. If this downward spiral continues, Bloomberg's report warns that 2024 could witness the first annual net outflow of funds from China since at least 1990. This would also disrupt a 33-year streak of increasing foreign direct investment. This decline follows a record high of $3.44 trillion in foreign investment reached in 2021. Contributing factors include a slowing Chinese economy, escalating geopolitical tensions, and China's rapid shift towards electric vehicles, which has left many foreign automakers scrambling to adapt. Last year, foreign investment growth hit a record low. Despite this, the Chinese government is striving to maintain an image of openness and attractiveness to foreign companies, hoping they'll continue to bring in advanced technologies and resist pressure to decouple from China. Data from the Ministry of Commerce shows that China's actual use of foreign capital in the first half of this year was 498.91 billion yuan, roughly $69.5 billion, a year-on-year decrease of 29.1%. This decline has been steadily worsening since January. There are discrepancies between FDI data from SAFE and the Ministry of Commerce due to differing statistical methods. Guan Tao, global chief economist at Bank of China Securities, clarified that the ministry's data reflects equity investment, excluding bonds from affiliated companies, while SAFE's data is more comprehensive. Both datasets, however, indicate a waning attractiveness of the Chinese market to foreign capital. SAFE's data, tracking net capital flows, reveals trends in foreign companies' profits and operations in China. As developed economies raise interest rates while China cuts them, multinationals have more reason to keep capital abroad. Meanwhile, foreign investors are selling off Chinese stocks. Last Friday saw a net sell-off of nearly 7.8 billion yuan, about $1.1 billion, of A shares, shifting the year's balance to net selling. Bloomberg reports that over the past week, northbound funds were net sellers on 3 out of 5 trading days, with a total net sell-off of nearly 15 billion yuan, about $2.1 billion. Year-to-date, they've sold over 1.7 billion yuan, about $230 million, in A shares. UBS's latest report reveals a 10-year low in Chinese stocks held by the top 40 global investors. About 190 of the 820 foreign-managed active funds tracked by UBS have fully divested from Chinese stocks. The total value of Chinese stocks held by these funds has dropped to 6.6% of their portfolios, 2.4 percentage points below the 9% benchmark, equivalent to about $150 billion. This trend is widespread. 70 Asian funds, 506 global funds, and 244 emerging market funds all hold less Chinese stock than their benchmarks, at 26.1%, 2.8%, and 19.2% respectively. Despite Chinese officials' efforts to attract foreign investment, the effectiveness of these policies remains uncertain amidst global geopolitical tensions. Associate Professor Fu Fangjian from Singapore Management University notes that while China's policies are aggressive, the impact of international relations cannot be ignored, suggesting a complex outlook for foreign direct investment in China. China's domestic demand weak, multinational companies, consumer confidence extremely low. Major multinational corporations, including Volkswagen, AB InBev, and L'Oreal, have expressed concerns over the weakened domestic demand in China. They report that the decline in consumer confidence in China has significantly impacted their performance in the first half of this year. In its recent earnings report, London-listed advertising giant WPP Group highlighted the challenges in the Chinese market, revealing a nearly 25% drop in sales over the past 3 months. The report noted that Chinese consumers are increasingly cautious. L'Oreal, a leader in luxury and beauty products, reported a 2% to 3% decrease in sales growth in China during the first half of this year. Porsche, a subsidiary of Volkswagen, reported a 1/3 drop in sales in China over the same period compared to last year. Fitch analysts have noted that the growth rate in China's catering industry slowed to below 8% in the first half of this year, marking the first time since 2010, outside the pandemic period, that this threshold has been breached. They explain that uncertainties surrounding disposable income, coupled with declining property values, have led to reduced spending on non-essential items or a shift toward value-for-money products. This trend has extended from the catering sector to other consumer categories, including clothing, cosmetics, and jewelry. L'Oréal Group CEO Nicolas Hieronymus remarked, "China remains the only region globally where consumer confidence is still very low." He pointed out that China's employment market is not healthy, with many people having invested their savings in real estate, only to see property values significantly decline. On August 7, Beiersdorf, the maker of Nivea, also reported that the slowdown in China's luxury market has negatively impacted sales of its La Prairie brand, resulting in lower-than-expected half-year operating profits. Volkswagen and Porsche CEO Oliver Blume mentioned that it remains uncertain whether the demand for electric sports cars like the Porsche Taycan will recover in China. He said that there is currently no significant market for luxury electric vehicles in China. Mercedes-Benz, which has shifted its focus to more expensive models in recent years, saw a 9% decline in car sales in China in the first half of this year compared to the same period last year. CEO Ola Kalenius attributed the cooling of China's luxury market in part to the country's real estate crisis. He said, "We are unsure how long it will take for Chinese consumers to regain confidence." Additionally, beverage group AB InBev attributed the 15% drop in its second quarter sales in China to weak consumer demand and adverse weather conditions in parts of China. In the face of these challenges, the outlook for China's domestic demand remains uncertain, leaving multinational corporations cautiously monitoring the situation as they navigate a complex and evolving market landscape. China's financial tea scandal, Billion-Yuan money laundering and investor exploitation. According to various Chinese mainland media outlets, multiple financial tea investors revealed on August 10 that the total funds involved in the latest scandal exceed 10 billion yuan, about $1.39 billion. Industry insiders estimate that this may be the largest financial tea incident in the history of Guangzhou's Fangsuan tea market. Documents circulating on social media indicate that on July 22, Fancha Holdings announced a delay in the delivery of orders due to the freezing of its bank accounts, pushing the date back by 10 days to August 2. However, on August 3, the company abruptly announced that it was undergoing asset liquidation and reorganization, with specific plans to be disclosed after the shareholders and distributors meeting. The collapse of Fancha Holdings now seems inevitable. Despite repeated warnings in recent years about the risks of financial tea speculation, many investors, attracted by the promise of high returns, believe they wouldn't be the last one holding the baton. In Fangsuan, there's a saying, "Get in early, and you'll profit big, get out late, and you're the one being exploited." This saying now resonates strongly as Fancha's collapse unfolds. Public records reveal that Fancha Holdings, Guangzhou Company Limited was established in September 2022, with Xing Chaozhen as the legal representative and a registered capital of 10 million yuan, about $1.39 million. The company is 62% owned by Xing Chaozhen and 38% by Xing Haihua. Two other companies, wholly owned by Fancha, were established in 2021, Fancha Network Technology, Guangdong Company Limited and Guangdong Fancha Tea Industry Company Limited. Fancha's products are known for their premium prices, with items like the Ilu Changhong tea cake once trading for 120,000 yuan, about $16,700, per piece. Another product, 2021 Ichi, reportedly reached 610,000 yuan, about $85,000, per set, approximately 244 yuan, about $34, per gram. However, Fancha's business gradually shifted from traditional tea sales to financial speculation. The company packaged high-end pu'er tea as a lucrative financial product, selling it at prices far above market value. Similar to other financial tea schemes, Fancha's speculation chain involved the company, platform, distributors, and customers. The trading platform promised high-interest buybacks at maturity, inflating tea prices. Mrs. Lin, distributor from Fujian, said, "I spent 8 million yuan on Fancha in June 2023, and within 6 months, it more than doubled." Later, I invested everything, and now I can't cash out a single penny. Mr. Liu, distributor from Chaos Han said, I came across Fancha's model in early 2023. At first, I thought it was a scam and ignored it, but more and more of my tea friends were making money. In August last year, I invested 6 million yuan, and it quickly doubled, too tempting to resist. This scandal comes just 8 months after the collapse of Changsha Tea. The financial tea industry, with its futures-like attributes, has been plagued with scandals, especially in 2021, 2023, and now 2024, with increasingly frequent explosions. As analysts suggest, the tea industry is China's largest money laundering channel, with tea's unique properties making it an ideal tool for laundering illicit funds. The ongoing Fancha scandal serves as a stark reminder of the risks hidden behind the allure of financial tea. Wall Street cuts hiring. Chinese students face increasing difficulty in finding financial jobs. Chinese students seeking financial jobs are facing unprecedented challenges as Wall Street cuts back on recruitment. The youth unemployment rate in China remains high, and with the economic slowdown and real estate market struggles, securing a position in the financial sector has become increasingly difficult. Some students are spending up to $50,000 on career coaching services, hoping to land their dream jobs, but many are finding themselves empty-handed. Official data shows that in 2024, China produced a record 11.79 million college graduates. A recent report by Xiaopin reveals that by mid-April, only 48% of these graduates had received informal job offers, a situation worse than last year. With layoffs hitting the financial, real estate, and tech sectors, competition for jobs at major Wall Street firms has become fierce. According to a Bloomberg report, Goldman Sachs received over 315,000 applications for its 2024 summer internship program but only accepted 2,600 interns, resulting in an acceptance rate of just 0.8%. As competition intensifies, some students are willing to pay high fees for job search assistance. Consulting firms help with resume polishing, interview preparation, and even internal referrals, aiming to secure positions at investment banks and hedge funds. Despite success stories, the competition remains tougher than ever. One student at the University of Pennsylvania spent $50,000 on career coaching, seeking an internal referral for an interview at a global investment management firm. Despite having internship experience, 8 months later, the student has yet to secure a job, expressing feelings of despair. Even students who secure internships are not guaranteed full-time job offers. Annie Lin, chief academic officer of the Shanghai career coaching firm Wall Street Tequila, told Bloomberg, before the pandemic, the probability of students getting a full-time return offer after completing a summer internship was 70% to 90%. But since the pandemic, most companies' return offer rates have dropped below 30%. Western investment banks are also reducing their presence in China. The ongoing slump in the Chinese real estate sector and escalating tensions with Western countries have slowed capital market activity. Recent reports show that 5 out of 7 Chinese securities firms under Wall Street and European banks reported losses or profit declines, leading to layoffs. These 7 securities firms employed 1,781 people in 2023, a 13% decrease from 2022. J.P. Morgan Chase CEO Jamie Dimon said at a meeting in May that the bank's investment banking business in China has seen a cliff-like decline in recent years, highlighting the challenges faced by Western financial institutions in China. Bloomberg reports that Morgan Stanley plans to cut about 50 investment banking positions in the Asia-Pacific region, with at least 80% of these layoffs occurring in Hong Kong and China. As China's economic growth slows, experts believe that better investment opportunities may lie in emerging markets outside of China. BlackRock's global chief investment strategist, Wei Li, notes that the risk-adjusted attractiveness of investing in China has diminished, prompting a downgrade in the institution's investment rating for China. Massive spending and the politicization of sports, CCP's Olympic system criticized. For years, the CCP has invested vast amounts of money in its pursuit of becoming a gold medal powerhouse at the Olympics. The Paris 2024 Olympics is no exception, but the CCP's approach has drawn increasing criticism for allegedly violating the true spirit of sportsmanship. Leveraging major international sporting events, particularly the Olympics, to promote the CCP's authority has been a long-standing strategy. Following the Cultural Revolution, as China prepared to rejoin the Olympics in 1979, winning gold medals was elevated to a so-called important political mission. Over the years, the CCP has repeatedly launched Olympic strategies, utilizing what it calls a whole-nation system to achieve its objectives. The whole-nation system refers to a model where the state takes full responsibility, with government departments overseeing operations and finances fully covered by the state. The CCP has established thousands of sports schools across the country, selecting children as young as 4 or 5 for specialized training. However, according to estimates by China Sports News, about 80% of retired Chinese athletes face unemployment, poverty, or chronic health issues due to missing out on formal education and enduring intense training. Zhu Bin, a former member of the Chinese national basketball team and now a basketball coach in Canada, commented, "The whole nation system may streamline efficiency in getting things done, but these artificial methods lead to more severe consequences. It's like a person taking banned drugs to achieve a goal, but later, certain organs might age prematurely, or blood vessels might rupture, or other organs become fragile. It goes against natural laws, leading to these severe consequences." While countries around the world invest in the Olympics, the scale of the CCP's spending is unprecedented. By 2024, the budget for China's State General Administration of Sports is set to reach 7.8 billion yuan, about $1.1 billion, with provincial budgets even higher. For instance, in 2019 alone, provincial spending totaled 45.8 billion yuan, about $6.38 billion. Chinese athletes seem to receive preferential treatment, with official documents ensuring they are given special privileges, such as police escorts and running red lights during their travels. At the Paris Olympics, the CCP sent a large delegation, with 716 athletes and more than 400 reporters, but public attention to gold medals continues to decline. After 3 years of pandemic lockdowns and economic downturns, with youth unemployment, middle class and small businesses bankrupt, white-collar workers facing pay cuts and job stress, ordinary people are suffering immensely. Some netizens question the expenditure, asking, how much money is being spent to send so many people to Paris? Wouldn't it be better to use that money to support the unemployed? Others wonder, what does winning gold medals have to do with ordinary citizens? Don't forget to leave a comment in the section below to share your opinions on today's topic with us. Make sure to like and subscribe to see more interesting topics from China Truths.